I am so excited for this Finance Friday. So the last time we spoke, we talked about cryptocurrencies, and then we started to get into an off conversation about the Federal Reserve Bank and Fed. So tell me, what's the Fed, and why should I even care about them?
Yeah, so what is the Fed? The Federal Reserve is our system of banking, really. And it's a misnomer because it says Federal Reserve and you think, oh, it's a government entity. You can go on the website and it's federalreserve.gov, right?
Right.
The truth is, it's not actually a government entity at all. It's a conglomeration or a meeting of the top banks in the country, and they control the money. There is a chairman of the Fed who is appointed by the president, whoever's the president at that time, but they serve longer than presidents do. I think I can't remember the term. You can look it up, but it's 6 or 8 years. So they serve longer than a president does. They're appointed by a president, but they're fairly independent. They're not controlled by the president. They're not controlled by Congress. They're not controlled by the Treasury. They are their own thing. So they do things like, the primary thing that they do is set interest rates.
Okay.
And they set the and you see this all the time, is what's the Fed going to do? Are they going to raise or lower the interest rate? What is the interest rate? What they're raising and lowering is the interest rate that banks charge each other in between each other to shift money around. So that's the thing that most of us understand about the Fed, is they control the interest rates. Why do they do that? It's a very blunt instrument that they can use to control loosely the economy. It's too hot. It's too cold. Raise the interest rates. Move more money. Slow down the money. So roughly speaking, that's what the Fed does. And they meet every once in a while. But they're the bankers. And that's what's really interesting about them. It's the bankers, and they're independent, and they control our money supply.
Makes sense. If that's the case, then how does money work?
Yeah, what is money in the first place, right?
Right.
So there's if you look at, I don't even have any paper money. I was gonna show you a dollar bill, but I don't even have any. So we have paper money, and we all used to use paper money a lot. Nowadays you use credit cards of various, or just cards, right? Plastic, or it's all online, so you don't have paper. But what is money? Money is just something that we've all agreed has some value. I can give you a note, a piece of paper, or you swipe your card, and you will give me some good or service. Right. So money is just the way of marking that transaction. I have 100 pieces of paper. Each one of them says 20 on it. And we all agree that I can give you one of these pieces of paper and you'll give me a cookie or a meal or some shoes or whatever. And I got that pile of paper from working my job, and they got their pile of paper because we created a good or service and someone gave them a pile of paper. So it's just the thing that we can all exchange. Yeah. In various cultures throughout history, money could be anything, right? We talked about this in the beginning. Money could be shells or sacks of salt or pieces of gold. Money can be anything. It's just an indicator that we both agree that a certain amount of this thing can be handed over for something else. Now, and I think we'll have to talk about fractional reserve banking because it's very important, but money is just that thing that allows us to trade with each other.
So you said we're going to talk about fractional reserve banking.
Yeah.
You brought it up. Tell me about it.
That's a mouthful, isn't it? Yes. Fractional reserve banking. This is an American invention. So back in the day, way back, we used to have, you could tie money to an actual thing. It's like, even the invention of money is interesting, but I hand you this one gold coin. And if you want to loan that gold coin out to someone else, you have to physically give them that gold coin. And you say, I'm going to give you this gold coin, but when you return it, you're going to give me a gold coin and a half.
Right.
That's kind of interest. The physical gold coin, I hand it over to you. It's no longer in my possession. All I have is a note from you that says I promise to give you back the gold coin, right? I could take that gold coin and I can cut it up into 8 pieces, let's say. So now I can hand out 8 smaller pieces of gold coin, but it's still only one gold coin, right? Now, fractional, and we all understand this. I'm going to give you a piece of 8. pieces of 8.
Mm-hmm.
I'm going to give you one little piece of 8, and you're going to give it back to me with some interest. So you're going to
Right.
give me maybe 2 pieces of 8 or whatever we agreed on. Okay. When I run out of all 8 pieces, I can't loan to anybody else.
Mm-hmm.
It's like all I had was 8 pieces of gold.
I know it's
I
done.
gave them out. They're all gone. Now I
Yeah.
have to wait and hope the people bring them back. And then I can loan them out again. And eventually I'm going to make more money because you're bringing me back more than I gave you. So it's okay. I understand that. Totally kosher. It's all good. Now, along comes fractional reserve banking. I know you gave me a gold coin. I cut it up into 8 pieces. But instead of just handing out 7, I handed out 20. How? I just made it up that I had more gold pieces than I actually had. So instead of actually giving you a physical gold piece, I give you a piece of paper that says this
I had
piece of paper is worth a gold piece,
value. Yes.
right? This piece of paper is worth a piece of 8, 1 of 8 of the gold coin. Here you go. And when you come back, give me back that piece of paper and another piece of paper
And
from
interest.
someone else that's the equivalent of the interest rate we agreed upon, right? Okay, I have the 8 pieces in my hand, and for each one of the 8, I hand out 1 piece of paper, but I still have all 8, right? That's okay. That makes sense. That's good. You're just keeping hold of them so that no one comes and steals them from whoever you gave it to.
Right.
You still have them all, and you only handed out 8, right? And then someone else comes and says, I need a loan too. And you go, no, sorry, I only had 8. I know you see the physical pieces here in my hands, but I can't give these to you because people have reserved them, right? These are not usable anymore. They're
Right.
just here.
Mm-hmm.
Okay. Okay, fine. Some smart brains in banking came along and said, hold on, you still have the pieces
Right.
and people are paying. Why don't you give out 12 pieces of paper, right? It's okay. Look, these people are repaying. So you're going to get it back eventually. As long as everyone doesn't come back and say, give me back my 8 pieces today, you can
Right.
hand out 12. It's all good. It's all good. So a regulator says, okay, the government says, okay, no, I see your scheme there. It's probably all right. But make sure you don't go below 4 pieces that you physically have for every one that you handed out,
Mm-hmm.
right? You need something in reserve. So we're going to let you hand out 12 pieces of paper, but
keep 4 actual pieces.
Yeah, so you can't hand out more than 32 pieces of paper. And you're like, oh yeah, okay, I got you. So you keep doing that and you say, you don't need to keep 4. It's okay if you keep 2. It's okay. You don't need to keep 2. You can just keep 1. So you can hand out 64 pieces of paper for those original 8 pieces that you physically had. And you can even give the physical pieces to other people and they can do the same.
Man.
This is called fractional reserve because you don't have the full reserve. You don't have all 8 pieces anymore. You only have a fraction of them. So you only have 1/8 of what you originally had, but you fully handed out 64 pieces of paper that said you had. No, each one of those is worth a full coin, right? I only have 1/8 of a coin here, but I'm over leveraged, right? But as long as everyone doesn't come back and say, I want my money back, you're fine.
You're fine. Yep.
Right? Now, when people do come back and say, look, I deposited a gold coin with you. I want it back now because I need to go buy something that requires gold. So as long as everyone doesn't come back at once,
then we're fine.
Then we're fine. Maybe if only 1/8 of the people actually come back and say, I need my gold coin now. It's like, okay, I got 1. Here you go.
Mm-hmm.
But if everybody that deposited gold coins comes at once, you're in trouble, right? Because you go, actually, the funniest thing happened. I gave away your coin and everybody else was, I don't actually have any back here. I got this 1 for all 80 of you people who are asking for it. I'm going to close the doors. So that's fractional reserve banking. It's just a system that allows us to hand out more money than actually exists.
Yeah.
Right? Now, there's a funny story here about what happened with gold confiscation in the US, in the world, back between the 30s and the 70s. But I think we'll get to that.
Okay.
So that's fractional reserve banking, is the fact that we can essentially just manufacture money.
Okay.
You just create it out of thin air, right?
Yeah. Makes sense. Doesn't
It
make
makes
sense,
total sense.
but it makes sense.
It's scary as all heck to
It's
realize
scary.
that our whole system is built on a house of cards
Cards,
sitting on
and you can crash.
sand,
Yes, at any time.
and it can
Once
all
we
just
don't.
fall apart in a second. And it teeters on falling apart every once in a while. And we have these
Yeah.
big motions and crashes and stuff like that. But that's the system we have.
Wow. So this is completely different than bonds, because we were talking about investing in bonds before.
Yeah.
And so tell me, like, what's bonds and why should I invest in them? Because
Yeah.
I see the similarities, but they're different. So,
Yeah, what's a bond and what does it have to do with fractional reserve banking and all the rest?
Yes.
All right. A government, whether it's local or state, federal, whatever, says, you know what, we need some money to do whatever it is we want to do. So at the federal level, the US says, all right, there's a pandemic going on. We need a couple $1 trillion that don't exist just to hand out to the people so they can go and gamble and entertain themselves while we have them locked at home. So the government says, all right, we need some money, right? We need to print up a whole bunch of dollars or just change some numbers in the computer. We need a couple $1 trillion. That doesn't physically exist. That gold does not exist.
Right.
So they essentially, they go, where can we get it from? And the Federal Reserve is what do they call them? The lender of last resort. So they turn to the Federal Reserve and they essentially say, we need a couple $1 trillion. And they're essentially telling them, we're giving you permission to print $2 million. Just make it up. Just make some ledger entries, and suddenly $2 trillion appears.
Will appear.
Now
Yes.
start handing it out, right? Make more loans. We're going to write some checks to give directly to people. So you just make it up, right? Now, when they do that, they have to, the government side of it is they create a bond, okay? And it's essentially a way of saying, all right, I know we made up this money, but we have to have a balanced ledger sheet that shows, well, where did it come from? It comes from the government saying, here's a bond. We're going to float a bond for a couple $1 trillion, and it's going to have an interest rate. So it's like, we're borrowing this money from the banks. Well, we know it's all just made up. So we're borrowing this money from the banks, $2 trillion. Here's the bond that represents the money that we're borrowing. And it has an interest rate. And the interest rate is based on some percentage above whatever the Fed sets as the interest rate. So I, as a customer, as a consumer, can purchase a bond. It's like, oh, I'm in for that. Here, I'll give you $1,000. You give me one of those bonds, and you're going to give me back 4% interest, right? In 10 years, 30 years, whatever it is. And the interest is determined by the Fed. Okay, great. So at the Fed, so what happens is the Fed can raise the interest rate. And if your bond is based on the Fed's interest rate, then your interest is going to go up.
It's going to go up, right.
Right? And they can lower the interest rate.
Right.
All right. So the relation, okay, so we understand this. It's like someone has to come along and buy the bond. Now, for the US, a lot of cases, it's the government itself that buys its own bonds, which is really tricky. It's, wait a minute, aren't we going circular here? It's, yeah, a little bit. But you could buy some too. Okay.
Right.
You as a retail investor, you can buy bonds. So you buy a few and you're like, why would you buy bonds? Because the interest rates are high right now.
Right.
Relatively high. And the US government, they're good for it. I know I'm going to get if they said it's 4%, I know I'm going to get my 4%. In 10 years, they're probably not going out of business. It's a good investment.
Right.
And everything else is putting your money in the bank. I'm not getting 4% out of a bank. I'm getting 1% or even negative. So this is a good investment, right?
Okay.
When the interest rate is high, and we call this zero risk money, right?
Okay.
You're going to earn your 4 or 5%, and there's pretty much zero risk. You're going to get your money back, right? Plus the interest. Okay, great. Now, when the bond, now how much money you make off of your $100 is called the yield, right?
Okay.
So higher interest rate means higher yield, annual percent yield. Yield is just what percentage of profit are you making on this thing. If the bond price itself stays at $100, the difference between that and the interest rate, higher percent means higher yield, right?
Right.
The price stays the same. If the interest rate comes down, then the yield is less. So the bonds look less attractive, right? All right. So how does this relate to investing?
Right.
If the interest rate on bonds, which is easy money, is high, then people who are doing risk analysis of their investments are going to say, why should I invest in the stock market where my yield might be 7%? But it's so risky because stocks go up and down and people go out of business. And I'm going to take money out of the stock market and I'm going to put it into bonds because 4 or 5%, that looks pretty good. Low risk money. I'm going to do that because I'm in it for the long haul anyway. I'm going to shift some money, right? If the percent goes down on bonds, so if the Fed comes out and says, okay, we're going to lower the interest rate, that means the percentage is going to go down. The yield is going to go down. Now you as an investor are like, okay, those bonds are down at a 3% yield. I don't know. I could get double that yield by investing in the stock market because I can get 7% in the stock market. It's a bit more risky, but I'm pretty sure I can get my 7 to 10%. Historically, it's 10%, right? S&P 500, 10%. It's more risky, but it's double. So this is the relationship between the bond prices and the interest rates that the Fed sets and the stock market. If they say, so when, this is why we're all so like, oh my gosh, what's Chairman Powell going to say today? And the stock market will anticipate what he's saying. If he says, oh, we're going to start easing interest rates down, then the stock market goes crazy. People start going, all right, everybody out of the pool, everybody out of the bond pool is back to the stock market. Let's hit them blackjack tables. So that's the relationship. If the interest rates are going up, you'll see that the stock market is stagnant, right? Because everyone's, I don't know, man, those bonds, that looks like a better bet right now. And then as the money becomes more free, right? Because the interest rate is going down, so your cost of borrowing is decreased. Then people go, yeah, let's borrow. Let's work on margin and let's go invest in the stock market, right? It's just gambling. So let me shift my money out of the 3 or 2% that I'm getting in the bond market and let me go put more into the stock market. And that's when you see the prices go up. And you can just track the trend. Every time they raise interest rates, the stock market will dip. Every time they lower their interest rates, the stock market will go up. That's the relationship of those two things. Does that make sense? That's a long explanation, but that's what it is.
It's good to know. It's good to know.
Yeah.
So you were just talking about gold a minute ago and the value of gold and how, as an example, what's happening with gold now and presently?
Oh my goodness. Here, let's take a look at today's gold price just for kicks. So there's a thing with gold called the gold spot price. The spot price is if you wanted to go out somewhere and buy a physical gold coin or gold bars or whatever, everyone will go look at what they call the gold spot price, which is just what the world agrees gold is worth at any given moment. And it's relative to also every currency in the world. Not every, but pretty much every currency in the world. How many US dollars per ounce? How many yuan per ounce? How many rubles per ounce? How many rupees per ounce? And it's all ounces or troy ounces or whatever. Right this second, gold is 2,336 US dollars
per ounce.
Okay, per ounce. If we look back over 5 years, so 5 years ago, gold was $1,416 per ounce. That represents a 72% increase in the price of gold over the last 5 years. Okay, so what does this mean? Gold is just a bellwether sort of thing. You don't really use gold. You do use some gold in electronics and stuff like that. But for the most part, it doesn't have any intrinsic value. It's just a thing that the world has said that shiny rock has is a store of value. So
Right.
we're all going to agree that you can make your currency relative to gold and will fix a value, right?
Mm-hmm.
So the fact that is one way of thinking of it is, wow, if I had bought gold 5 years
Years
ago,
ago, I would
I
have
would have
been
almost doubled my money.
doubled your money. That's right.
Well, what does that mean exactly? What it truly means is, yes, the price of gold has gone up relative to the US dollar.
Mm-hmm.
What it means is the US dollar has decreased in purchasing power by that much over
Wow.
5 years. So what would have cost you $100 5 years ago is now going to cost you
$75.
$175. That's what it means. So okay, on the one hand, yeah, I got rich if I had gold. If you had taken all your money and converted it to gold 5 years ago, you'd tread water.
Mm-hmm.
While all your neighbors would lose their purchasing power. You'd stay high, right?
Yeah.
It looks like you got rich. Now, only if you sell it. But if you just want to preserve the value that you have, you want to have some gold. You want to have something that's stuck on the shore, a
Right.
rock, right? Something that doesn't fluctuate as much. The US dollar, as we know, because of fractional banking, gets diluted. Every time we
Right.
print $1 trillion more, that means every dollar that's out there is worth that much less. You didn't create any wealth. You just printed a lot more dollars, right?
Mm-hmm.
But it's still only worth whatever it was worth. So a loaf of bread was a dollar. Now a loaf of bread is $1.75. So gold has that property where it's a bellwether, it's a rock for the entire financial system of the world. And what's happening right now and why the price is just recently, let's just go back to March of this year. It was, or February of this year is 2024 per ounce. So it's gone up by $300 per ounce
In
since
3 months.
February. So how does that happen? Because gold, the U.S. has a lot of the gold that's in the world. By far, we have the most gold of anyone. Ukraine, Russia, there's some conflict going on over there. China, Russia against the US. They want a new financial system. They see us put sanctions on Russia. They see us block Russia's assets and block them from the banking system.
Mm-hmm.
And they're all, I think we're done with the US dominance. We want a new standard for money, right? So in order to do that, gold is still the one thing that everyone in the world agrees on. You can't just show up and suddenly say, you know what? We're now going to base our money on platinum. The rest of the world will go, that's nice. We're going to stick with gold. Right? So you have to go to where people are. And the only thing the whole world agrees on is gold, other than the US dollar, is gold. So China says, all right, we're going to purchase a bunch of gold like crazy. So they've been purchasing gold like crazy. There's this whole system called BRICS, it originally started with Brazil, Russia, India, China, Soviet, or what's the last one? I think it's South Africa. So they got together and said, what are we going to do about this American dominance in the banking system in the world? And I know, we'll come up with our own currency. Okay, BRICS. And now they've got other countries like, yeah, BRICS. And recently, over the last year, they're like, okay, we're going to make it's going to be based on gold and gold standard and all this. Yeah, okay. So this is why gold is going up. And another thing that's going on is a lot of these countries are starting to do some trade using gold as the medium instead of US dollars. Okay, which drives the price up because you and I, like, wait a minute, where's all the gold? It's being used for trade over there. So the price goes up. And you don't even see it in the transactions because it's not part of the banking system, right? So the price is going up. It's, oh man, I wanted to buy some gold earrings for my darling. Yeah, it's gone up $300 an ounce in the last 3 months. You better get that quick. So this is what's happening with gold. It's being purchased by a lot of countries, which is driving it up. And like I said in the beginning, yes, it's driving up whenever there's an up, there's a down. And the
Yeah.
down is the US dollar is decreasing in value, purchasing power is decreasing relative to gold, right? And it's mostly because we've just printed so much money. The roost is going to come home eventually. And here it is. And it shows up in this. And so when you look at things, and gold is also a good indicator. Another way of thinking about it is just that's inflation, right? Or
Right.
deflation, depending on which side you want to look at. It's inflation because things cost more. It takes more dollars to purchase the same thing because the value of the dollar is decreasing relative to this bellwether that the world agrees is the thing.
So what's my next move, William? We talked about bonds. We talked about gold.
Yeah.
What should be my next move?
You have and plenty of people, if you're following Finance Friday, you have a portfolio that's pretty steady, heavy towards stocks right now, maybe some dividend stocks and things like that. We're in it for the long haul, right? It's like you create a portfolio, you're going to earn your 5 to 10%. Your 5 to 10%, you're happy. Talking about bonds and gold and fractional reserve bank and all that sort of stuff just gives you another layer of the onion to look at. Any portfolio, my portfolio, I shouldn't say any because I'm not a financial advisor. My portfolio is fairly balanced amongst things like the different asset classes that we talked about in the very beginning. It's like property versus stocks versus bonds versus gold. So I would say once you get settled on okay, I've got my $100 a month going into whatever, my stock portfolio, take a look at another asset class.
Okay.
Bonds, gold.
Okay.
And say, all right, I want a little bit of gold because I know now that if I just hold stuff in US dollars, it's going to decrease in value over time because of inflation. So I need to offset that by having something more solid like gold. So just add gold into your mix and say, all right, maybe I'll buy a little bit here and there. I prefer physical gold, and there's different ways of getting into gold. You can get into what they call a gold ETF, which is like a stock that's backed by gold.
Okay.
I'd like to physically have it because those ETFs is like, it disappeared. Where's my money? It's like, sorry, we lent it out. So your next move is consider other asset classes like gold. Do some research, see what is the trend on the gold price, and then get in not when it's high. If it's heading up like this, don't get in then. Wait till it's headed on its way down, and it goes up and down. So heading on the way down, buy a little bit, buy a little bit, buy a little bit, right?
Okay.
So there you go.
Sounds like a plan. Sounds like a plan. All right, William. So that's it for this week's Finance Friday.
That was action packed.
Next week we are going to talk about your. I think next week we're going to talk about portfolios and what you have in your portfolio.
That sounds good.
All righty.